So recently there was a book written that made some arguments that the markets are actually rigged against the smaller investor. Sounds like this guy was mad that he lost some money in the markets, huh? So to oversimplify, high frequency trading are a bunch of computer models that trade the markets. Now how they do it, that's what the book was about, claiming that it put the individual smaller investor at a disadvantage. All right, so let's kind of talk about this. I'm going to oversimplify this. Let's say you're in Florida and you want to buy a stock for $20, okay? So you see a seller of that stock for $20 and you think you have a deal. So you place your order and in a matter of seconds, the order goes to the exchanges and you think you're going to have some kind of a deal for $20. Well, the deal is the high frequency trading systems are closer to the exchanges. So we're talking a fraction of a second here, but if you're in Florida and it takes 1 second for the system to communicate with the exchanges and they're right across the street from the exchange, well, you can see how they're going to beat you to that exchange much faster than anybody could. Basically, they can see your order coming. Now again, I'm oversimplifying this. You send your order for $20, they can choose to interact with that order, meaning choose to sell you the stock for $20, or they may say, hey, we see a bunch of orders coming in for $20, we're gonna raise our price to $20.01. Now at that point, you have the choice to either raise your buy order to $20.01 or sit and wait and hope that someone else comes and sells for $20. Now it's the same on the downside. Let's say you want to sell your stock for $15, but as you send your order, tons of other people send their orders as well. No one's going to decide, hey, I'll pay $15 for something that everyone wants to sell. So in that case, the high frequency trading systems would lower their bid and maybe offer to buy at $14.99 rather than $15. Same thing, you'd have to decide, well, do I want to change my order now to $14.99 or just wait at $15 and hold steady on my price? Now that's not all that they do, but that's just a real simple explanation. If you're really not interested anyways, that's a quick way to kind of oversimplify the high frequency trading system. Now the goal of these systems is to do these types of trades millions and millions, if not billions of times a day, and they profit off of that 1 penny difference, or a lot of times a fraction of a penny. All that means for you is that when you place the order, you may have to raise your order by a penny to buy something, and you may have to lower it by a penny or two to get out of it. Not always, but that's what it might mean. See, it can work in your advantage too. You could be offering to sell a stock at a certain price, but the systems recognize that you're selling too low, and you may actually be able to sell for a little bit better of a price than you think. It's not going to be a lot. It's going to be like a fraction of a cent or maybe 1 penny at best. In my experience, this happens more times than not. I put an order in to buy, and usually I'll get a better price than what I put the order in. If I put an order to sell, I'll get a slightly better price than what I wanted to sell for. So does this mean that the market is rigged against you and your slow computer just can't compete with those that have faster computers? No, not at all. No. People get all fired up about this, but if you have to pay a penny more to get in every now and then, or you get a better price every now and then to get in and out, that's not so bad. That's a great feature of the US markets. See, in other markets around the world, you may want to go buy a stock for 20, but the closest seller is at 25. That's a big difference. If you met in the middle, that would cost you an additional $2.50. That's ridiculous. See, these computer systems provide what we call a liquid, tight market. It means that there are tons of orders there. You can interact with those orders any way you want, and they're really, really close together. So if you want to buy or sell something, we're talking about a penny or a fraction of a penny difference. Now this is a huge advantage because I always say to have access to your money at a moment's notice is one of the most important aspects of investing. This is why I don't flip cars or houses or baseball cards, because if you buy a house and you fix it up, there's no guarantee that someone's going to come along and buy that house from you at the price that you want, let alone what you paid for it. See, you may even have to wait months to get your money back, if you even get it back at all. Not so in the markets. By paying that extra penny or fraction of a penny every now and then, those high frequency trading systems allow you that quick access to your money no matter what you have it invested in. That's a good thing no matter what anybody else tells you. Now, hopefully you found that helpful. If so, do us a favor, go be our friend, subscribe over on YouTube, check out our website, jazzwealth.com. We have tons of other great videos in the helpful videos section. And remember, we manage retirement accounts here. If we can ever help you with your retirement accounts, IRAs, 401k rollovers, anything like that, you can always contact me directly at